Most people invest in stocks. They put their money into the S&P 500, they watch the ticker go up and down, and they hope that over 30 or 40 years, compounding does its magic. And that's fine, it's a valid path. But the wealthy, the people who aren't just trying to retire comfortably but are actively building generational fortunes, they buy entire businesses, quietly, strategically, and profitably. They don't just own a piece of the pie, they buy the whole bakery. This is the fundamental disconnect between how the average person thinks about wealth creation and how the ultra-successful actually build it. They're not playing the same game. One group is a passenger on the train, the other group owns the railroad. They understand a principle that's almost never taught in school, and certainly not on the nightly news. The greatest asset class isn't stocks or bonds or even real estate. The greatest asset class is business itself, a privately held, cash-flowing business. Why? Because you have control. You can't call up the CEO of Apple and tell him to cut costs or raise prices. But when you own a local plumbing company or a regional software business, you can. You can pull the levers. You can directly influence the outcome, which changes the risk-reward equation entirely. You are no longer a passive observer of the market. You are an active participant in value creation. Welcome to Wealthfully Yours, where we break down the real strategies used by entrepreneurs and investors who play the long game. We're not talking about get-rich-quick schemes or crypto gambles. We're talking about tangible, proven frameworks for acquiring and growing real assets that produce real cash. This channel is for the operators, the builders, the investors who understand that wealth isn't found, it's forged. It's built brick by brick, deal by deal, decision by decision. We're here to give you the blueprints that the pros use, the ones they don't share in textbooks or MBA programs because it's their competitive edge. Today we're unpacking the playbook. We're exploring 11 business and investing principles used by acquisition entrepreneurs, private equity professionals, and high net worth operators to build their empires. These aren't just theories, they are battle-tested rules of engagement for the world of private enterprise. From finding the right deals and structuring them with little to no money down, to optimizing operations and planning your exit from day one, this is the masterclass you wish you had. So grab a notebook, because we're not just going to change how you think about investing, we're going to give you a roadmap to actually do it. Let's get started. The hardest part of any business is getting from 0 to 1. It's the period of maximum effort for minimum reward. You're building the product, finding the first customers, hiring the first employees, and burning cash the entire time. It's a brutal, soul-crushing grind that sinks the vast majority of startups. So why would you willingly put yourself through that if you don't have to? The core principle of acquisition entrepreneurship is simple. It's easier to steer a moving car than it is to push a parked one. You are buying a business that has already survived the startup gauntlet. It has momentum. And momentum is the most valuable yet intangible asset you can acquire. Think about what that momentum actually means in tangible terms. It means revenue is already coming in the door on day one. You're not starting from zero, trying to convince the world your idea is worth paying for. Someone else already did the hard work of proving product market fit. You inherit a stream of cash flow that you can use to pay yourself, fund improvements, and service any debt. You're not just buying a concept, you're buying a working economic engine. This simple fact de-risks the entire endeavor to a degree that is almost impossible to overstate. You're stepping onto a moving walkway instead of trying to run up a sand dune. Beyond revenue, you're acquiring a team. You don't have to go through the agonizing process of recruiting, interviewing, and training people from scratch. You get a group of employees who already know the business, the customers, and the operational cadence. They know where the skeletons are buried and what makes the business tick. Sure, you might need to make changes, but you're starting with a functional team, not a blank slate. This is a massive shortcut. The time, energy, and money it takes to build a cohesive team from nothing is a hidden cost that bankrupts many founders. You get to skip that entire phase. And most importantly, you get customers. A list of people who have already voted with their wallets and decided that this business provides value. You don't have to spend hundreds of thousands of dollars on marketing to acquire your first 100 or 1,000 customers. They come with the deal. You have a built-in feedback loop and a foundation for growth. You can survey them, upsell them, and learn from their behavior to improve the business. A startup founder dreams of having a real customer list. An acquisition entrepreneur buys one. It's the ultimate shortcut to success because you're starting the race halfway to the finish line. Everyone chases the next tech startup, but real wealth is often made in boring businesses. Think landscaping, commercial cleaning, or plumbing. These businesses don't get headlines, and that's precisely why they're attractive. The lack of glamour means less competition. Often owners aren't sophisticated financial operators, creating an opportunity for savvy buyers. Apply modern business principles to unlock enormous value. Look at the durable, cash-flowing assets everyone else ignores. Section 2. The Tired Operator Opportunity. A great opportunity lies in acquiring businesses from tired operators. They're tired and have stopped innovating. This stagnation is your opportunity. The business is neglected, not broken. Bring fresh energy and modern strategies to a business with solid bones. These operators are motivated to sell and care about their legacy, creating openings for creative deal structures. When you find a tired operator, you're finding a problem you can solve, creating a win-win scenario. So you found a great business, but you don't have $1 million in cash. Most people stop right there. But the best deal makers see it as a puzzle to be solved, not a barrier. What you actually need is a compelling offer. And cash is just one component of that offer. The truth is, the seller's needs are often more complex than just a single lump sum payment. Your job is to solve their problem, and if you can do that, the cash requirement shrinks dramatically. If you come in with a creative structure, like seller financing, you're signaling something different. This is where seller financing becomes your superpower. Instead of you going to a traditional lender, the seller finances a portion of the purchase price, and you pay them back over time with interest out of the company's own profits. You're not just buying assets, you're solving a human problem for the seller. Your creativity in structuring the deal is a bigger asset than the cash in your bank account. Let's talk about another powerful tool in your creative financing toolkit, the earnout. An earnout is a beautiful way to bridge a valuation gap. You've completely de-risked the purchase. The earnout aligns incentives perfectly. Then you have equity swaps. This is for more complex situations, but it's a game changer. Instead of cash, you can offer the seller equity in your larger combined entity. This is how you do big deals without big cash. Stop thinking like an employee who trades time for money, and start thinking like an owner who trades creativity for equity. The person who can look at a seller's needs, a company's cash flow, and a market opportunity and weave them together into an irresistible offer will win every single time. People get obsessed with the wrong things. They get seduced by vanity metrics, revenue, team size, office space, Instagram followers. It's all ego, but ego doesn't pay your bills. Ego doesn't fund your growth. Ego doesn't make you wealthy. Cash flow does. I want you to burn this into your brain. Revenue is vanity, profit is sanity, but cash is king. A business that does 10 million in revenue but has zero cash left at the end of the month is a high-stress, low-value job. A business that does 1 million in revenue but spits out 300,000 in free cash flow is a beautiful, valuable asset. It's an engine that prints money. So what is cash flow? It's simple. It's the cash that's left over after you've paid all your expenses, including your taxes and any investments back into the business. It's the money you can actually take out and put in your pocket without hurting operations. This is the single most important number in your business. It's the true measure of the health and value of the company. When you're looking at a deal, you're not buying revenue. You are buying a stream of future cash flows. That's it. Everything else is just noise. How much cash can this asset generate for me, the owner, over time? This focus on cash flow changes how you operate. You stop chasing every shiny object. You stop saying yes to low-margin clients. Instead, you start asking ruthless questions. Does this new hire increase our cash flow? Does this marketing campaign have a positive return? Does this software subscription generate more cash than it costs? Every decision gets filtered through this lens. It forces you to be disciplined. It forces you to build a resilient, efficient business, not a bloated, fragile one. A business that's rich in cash can survive recessions, seize opportunities, and sleep well at night. And here's the real secret. Cash flow is what pays for your acquisition. When you structure a deal with seller financing or a bank loan, where do you think the money for those monthly payments comes from? It doesn't come from your savings account. It comes from the cash flow of the very business you just bought. The business buys itself. This is the most powerful concept in acquisition entrepreneurship. You're using the asset's own output to pay for the asset, but this only works if the business has strong, predictable cash flow. That's why it's the non-negotiable foundation of any good deal. Cash flow is more than just profit, it's your ultimate defense mechanism. It's the moat around your castle. When you have a business that consistently generates excess cash, you are insulated from shocks. What happens when a key customer leaves unexpectedly? If you're running on thin margins with no cash, you're in panic mode. You might have to lay people off or miss payroll. But if you have a cushion of cash, it's just a Tuesday. You have the time and resources to replace that customer without desperation. Cash gives you options. It turns potential catastrophes into manageable problems. Think of it as building an anti-fragile business. A fragile business breaks under stress. A robust business resists stress. But an anti-fragile business gets stronger from stress. How? Because when the market panics, when your competitors are struggling, your cash-rich business can go on the offense. You can hire their best talent. You can acquire their customer lists for pennies on the dollar. You can invest in marketing when ad costs are low. Crisis becomes opportunity. Your competitor's weakness becomes your moment of maximum leverage, all because you prioritized cash flow when times were good. Furthermore, cash flow is the engine of all growth. How do you scale? How do you open a new location, launch a new product, or enter a new market? You need capital. You can either raise it, giving up equity and control, or you can fund it yourself from your operations. Self-funded growth is the holy grail. It means you maintain 100% ownership. You're not beholden to investors or banks. You control your own destiny. Every dollar of cash flow you generate is another soldier in your army, ready to be deployed to conquer new territory. It's a compounding machine that you own and control entirely. So when you're analyzing a potential acquisition, you need to be a detective. Scrutinize the cash flow statements. Understand the difference between net income on paper and actual cash in the bank. Are they collecting their receivables on time? Are they managing their inventory efficiently? Are there non-cash expenses propping up the net income? You have to go deep. Because at the end of the day, you can't pay your team with net income. You can't reinvest EBITDA into the business. You can only spend cash. It's the one metric that cannot lie. Master cash flow, and you master the game of business. Buying a business without deep due diligence is foolish gambling, not investing. Due diligence turns the unknown into the known, verifying the business you're buying. It's the number one reason deals fail. Be a skeptical journalist, trust, but verify every claim. Dig into the raw financials, bank statements, and tax returns. Look for consistency and red flags. This tedious process uncovers the truth and makes you money. Structure your due diligence around financial, operational, and customer diligence. Validate numbers and understand earnings. Look under the hood at systems and processes. Analyze customer concentration and acquisition. Ignoring any pillar is an insane risk. Due diligence separates success from failure. Most people focus on the flashy aspects of business, but they're wrong. The best businesses are ruthlessly efficient machines, built to produce profit with minimal friction. Operational efficiency is the engine that separates hobbyists from empires, allowing you to make more money with less stress. The game is about eliminating waste. True leverage comes from the systems you build. Obsess over creating standard operating procedures, SOPs, for every repeatable task. An SOP is you cloned, ensuring the business runs correctly every time without you. This creates freedom for your team and allows you to focus on being the architect of your business. Building these systems is the highest leverage activity. Take a machete to complexity and simplify. Automation handles low-value tasks, freeing up human capital for creative work. Building an efficient operation is a continuous loop of refinement. Operational efficiency is the foundation of scale. You cannot scale chaos. It's the invisible architecture that supports a skyscraper of success. Here's a hard truth. Not all revenue is created equal. $1 million in revenue that requires you to work 100 hours a week is a prison. $1 million in revenue generated by a system that runs while you focus on the next big move. That's freedom. That's the difference between a business and a scalable asset. Scalability is the measure of a business's ability to handle increased demand without a proportional increase in costs or complexity. It's about designing your business from day one with the assumption that it will be 10 times bigger. If your business model crumbles at the thought of 10 times growth, you don't have a scalable model. Most entrepreneurs accidentally build themselves a cage. Their business is built around their personal skills, their personal relationships, and their personal time. To grow, they have to work more. That has a hard ceiling. You only have 24 hours in a day. A scalable business isn't built on the owner's time. It's built on systems, technology, and other people's efforts. You have to ask yourself, if I got 10 times the number of customers tomorrow, what would break first? Would it be your customer support, your fulfillment process, your own sanity? Whatever the answer is, that's where you need to start building for scale. The foundation of scalability is decoupling your revenue from your time. How do you do that? Digital leverage is one of the most powerful tools. This means using technology to serve one-to-many instead of one-to-one. Can you turn your consulting service into a digital course? Can you build a software tool that solves the problem you used to solve manually? Can you use content to attract and educate thousands of potential customers at once? Every piece of content, every automated email sequence, every line of code is a digital employee working for you 24/7, for free, serving an unlimited number of people. That's infinite leverage. You also have to think about your business model itself. Is it designed for local constraints, or can it expand? A single brick-and-mortar restaurant is hard to scale. It's tied to one location. But a franchise model for that restaurant, that's scalable. An e-commerce business selling a physical product, that can be scaled globally with the right logistics partners. A software-as-a-service business, that's infinitely scalable with minimal marginal cost. You have to be ruthless in evaluating whether your chosen vehicle is a go-kart or a rocket ship. Both can be fun, but only one is getting you to the moon. So you have a model that's designed to scale. Now what? You need the mechanical components to handle the expansion. This means your financial, operational, and human systems must be elastic. Your financial systems need to be able to handle higher transaction volumes without breaking. You need clean books, clear reporting, and a strong grasp on your cash conversion cycle. When you're growing fast, cash becomes oxygen. You can be wildly profitable on paper, but die from a lack of cash because you have to pay suppliers before your customers pay you. You have to model this out and plan for the cash required to fund your growth. Operationally, your systems and SOPs, which we talked about in the last chapter, become even more critical. What works for a team of 5 will break with a team of 50. Your communication channels, your project management, your quality control, all of it needs to be built on a framework that can support more weight. This is where you invest in enterprise-grade software and build out more specialized roles. You can't have everyone being a generalist anymore. You need dedicated leaders for marketing, sales, operations, and finance. The structure itself must be designed to scale with the business. This brings us to the most important element, people. You cannot scale without leveraging other people. But you can't just hire bodies. You need to hire leaders and operators who can take ownership of their domains. Your hiring process itself must be a scalable system. You need clear role scorecards, structured interview processes, and a robust onboarding system to get new hires up to speed quickly and effectively. As the founder, your role shifts from being the best doer to being the best recruiter and developer of talent. Your ability to attract and retain A players becomes your primary constraint on growth. Finally, you need to think about market expansion. Are you going after new customer segments, new geographic regions? This isn't something you do on a whim. Each new market is like launching a new mini business. It requires research, a specific go-to-market strategy, and dedicated resources. You can't just translate your website and hope for the best. You need to understand the local culture, competition, and regulations. Scalability isn't just about getting bigger. It's about getting bigger intelligently. It's a deliberate, strategic process of building a machine that can conquer new territory without collapsing under its own weight. You can have the best strategy, the best product, and the most efficient systems in the world. But if you have the wrong people on the bus, you're going to crash. Or more likely, you're going to have to drag the bus uphill by yourself forever. Your team is not an expense. They are your single greatest asset and your ultimate source of leverage. A great team doesn't just execute your vision, they multiply it. They solve problems you didn't even know you had. They bring ideas that make the business better. Building a world-class team is the difference between building a company that's worth $1 million and one that's worth $100 million. When you acquire a business, you're often acquiring a team. Your first job is not to come in like a wrecking ball. It's to identify the key players. Who are the people that make the business run? Who has the customer relationships? Who holds the institutional knowledge? These people are invaluable. You need to re-recruit them immediately. Show them the new vision. Show them what's in it for them. If the previous owner was tired and coasting, your energy and vision for growth can be incredibly motivating for A players who are feeling stuck. Your goal is to retain the best and upgrade the rest. To build a team of winners, you need to give them a reason to win with you. A paycheck is just rent for someone's time. It buys compliance, not commitment. To get real ownership and drive, you need to offer upside. This means performance-based bonuses, profit sharing, or even equity. When your team members have skin in the game, they stop thinking like employees and start thinking like owners. They watch costs. They look for opportunities. They go the extra mile not because you told them to, but because their success is intrinsically tied to the company's success. Aligning incentives is the most powerful management tool in existence. This all starts with who you let on the bus in the first place. You must be radically intolerant of mediocrity. The old saying is true. A players hire A players, but B players hire C players because they don't want to be threatened. One mediocre performer lowers the bar for the entire team. You need a rigorous hiring process that tests for skills, but more importantly, for character and cultural fit. Are they hungry? Are they humble? Are they smart? You're not just filling a seat, you're adding a member to a championship team. Protect the integrity of that team at all costs. The ultimate goal of building a great team is to make yourself redundant in the day-to-day operations. Let me say that again. Your goal is to fire yourself from the job of running the business. As long as you are the main operator, the business is capped by your personal capacity. To truly scale and build an asset of immense value, you must elevate your role from player to coach, and eventually from coach to owner of the team. This requires a fundamental identity shift that most entrepreneurs struggle with. You have to let go of the vine. You have to trust your team to execute. This means hiring key leaders and operators who are better at their respective functions than you are. You need a head of marketing who lives and breathes lead generation. You need a head of sales who can build and manage a high-performing sales team. You need a head of operations or an integrator who can run the day-to-day, manage the SOPs, and keep the trains running on time. Your job is to find these people, give them clear goals and the resources to hit them, and then get out of their way. Micromanaging A players is the fastest way to make them leave. How do you manage this team of leaders? You don't manage their tasks, you manage their outcomes. This is where clear metrics and key performance indicators are essential. Each leader should have a handful of numbers that they are solely responsible for. The head of marketing has a lead goal. The head of sales has a revenue goal. The head of operations has a profit margin or customer satisfaction goal. You have a regular rhythmic meeting, weekly or bi-weekly, where you review these numbers. The conversation isn't what did you do? It's did we hit the number? If not, why not? And what's the plan to fix it? This structure frees you up to focus on the highest leverage activities that only the owner can do. What are those? Setting the vision and strategy for the next 3 to 5 years, building key relationships with partners, investors, or potential acquirers, allocating capital to the best opportunities for growth, and most importantly, continuing to recruit and develop top-tier leadership talent. When you have a strong team of operators running the business, you get to focus on multiplying its value. That is the final move. That is how you build a true empire. Most people get into business thinking about the beginning, but the pros start with the end in mind. Your exit strategy isn't just a plan for when you leave. It's the blueprint for how you build. It's the ultimate North Star that guides your ship through the inevitable storms of business. You start with a blueprint. If you plan to hold the business for cash flow, you'll prioritize stability. What if your goal is to sell the business in 5 years? Top-line revenue growth becomes paramount. Which option gets me closer to my intended exit? So what are the primary exit paths you can choose from? First, you have the hold for cash flow strategy. The second path is the strategic sale. The third major path is the roll-up or platform strategy. The right path depends entirely on your personal goals, your risk tolerance, and what you want your life to look like. Because when you know your destination before you start the journey, you're no longer just a business owner. You become an architect of your own wealth. So you want to buy a business? Valuation is a game of math and story. The math starts with profit, specifically seller's discretionary earnings, SDE. Apply a multiple based on industry standards, considering risk and growth potential. Dissect the quality of earnings. Dig into financial statements, looking for trends in revenue and margins. Adjust for risks like customer concentration or technological disruption by discounting the multiple. The other half is the narrative, your growth story. What untapped potential exists? This justifies the price to investors and yourself. It's your most powerful negotiation tool. The final price blends their past with your future plan. Master both, and you'll know how to make it worth a hell of a lot more. The ultra-successful understand, your network is your net worth. You cannot build an empire in isolation. The best deals come from conversations, from being in the right rooms. Surround yourself with people playing the game at a higher level. Engineer your environment. Join circles where deals are done, masterminds, investor groups, and high-level conferences. Provide value first. Listen, understand problems, and offer help. Givers, not takers, get the best deal flow. Hear about opportunities before they hit the open market. Getting into that network is your primary objective. How do you access this off-market deal flow? Identify key players, take them to lunch, ask smart questions, and show you're a serious buyer. Be hyper-specific about what you're looking for. Build relationships with other business owners and investors. Transform yourself into an active source of opportunity. When your network is strong, deals come to you. This is the end game. Look, these aren't TikTok tips. They're not flashy hacks that will be irrelevant next week. They're timeless business principles used by those who are quietly building real sustainable empires. The people who don't need to post their wins on social media because their bank account already knows the score. These principles don't just grow your income statement. They do something far more important. They create freedom. They create options. They create a legacy that lasts long after you're gone. This is about building a machine that serves you, not the other way around. It's about creating a life by design, not by default. The biggest lie we've been sold is that you have to be a visionary genius who invents the next world-changing technology to become wealthy. It's not true. That's the lottery ticket approach. It's high risk, high stress, and has a near zero probability of success for most people. The smarter path, the more certain path, is to simply master the game the wealthy are already playing every single day. They're not inventing, they're acquiring. They're not starting from zero, they're buying cash flow. They're not gambling on ideas, they're investing in proven systems and making them better. This path is available to anyone willing to learn the rules. You don't need to invent the next big thing. You just need to master the game the wealthy already play. It's a game of patience, diligence, and strategic action. It's about finding value where others see none and having the courage to act on it. This is how you build a fortress of financial security, brick by boring brick. This is how you take control of your own economic destiny. The playbook is right here. The choice to use it is yours. This is Wealthfully yours. Let's buy boring. Operate smart. Build quietly. See you next time.